Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Intelligence with Scarlet Fu and Paul Sweeney.
Concern about rising prices spooking investors.
What does renewables investment look like in the U.S.?
More tariff talk coming out of this administration.
Breaking market headlines and corporate news from across the globe.
The president wants lower interest rates. He wants a rate cut cycle.
How do you broaden out the AI play?
Are people just looking for something to worry about when it comes to China?
Bloomberg Intelligence with Scarlet Fu and Paul Sweeney on Bloomberg Radio, Originals, and the Bloomberg Business app.
On today's Bloomberg Intelligence show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we'll look at why Kraft Heinz' new CEO is halting the process of splitting the company.
Plus, a look at why T-Mobile added fewer mobile phone subscribers last quarter.
But first, we begin with a deal in the energy space.
This week, deepwater oil rig owner Transocean agreed to acquire rival Valaris in an all-stock deal valued at $5.8 billion.
The deal will create the world's largest offshore rig contractor by market value.
And this comes as offshore drilling has been booming, especially in deep waters. For more, we were joined by Scott Levine, our senior energy services analyst.
We asked Scott to break down who these companies are and the reasons for the deal.
Two of the bigger names in offshore drilling, Transocean has the largest backlog. Valaris has the largest fleet. Valaris's name may not be that familiar to a lot of folks here. It was actually a combination of two companies called Ensco and Rowan a few years ago. But they are two of the biggest offshore drillers. And I think that this deal really has both offensive and defensive motivations. Offshore drilling is in a little bit of a recovery mode, really kind of has been. Most of the drillers went bankrupt actually during the 2020-21 downturn. Transocean was really one of the only companies that did not go bankrupt. Valaris did. And so Transocean's kind of been saddled with all this debt as a result of not having their balance sheet wiped during a bankruptcy. And so that's been a limiting factor on their growth for quite some time. And this deal, which is an all-stock deal, will accelerate their deleveraging process and remove some of that burden from them and better enable them to capitalize on an upturn in offshore drilling. And the second thing that's important to note here is that it brings a jackup fleet. So a jackup fleet, jackups are basically shallow water rigs, okay, as opposed to the deep water drill ships or floaters. And Transocean had exclusively been a floater fleet. Jackups are more to the seabed. The seabed's lower in shallow water, and Valaris is one of the biggest players there. And so this gives Transocean exposure to the jackup or shallow water market, which has really undergone an interesting phase in that it was a bit of a downturn the last couple of years. The biggest jackup driller is Saudi Aramco. And a couple of years ago, Saudi Aramco made significant cuts to their drilling program. They essentially, Saudi Arabia abandoned plans to increase their oil production capacity to 13 million barrels a day. And what we've seen since then is a lot of jackup rigs being laid off effectively in 2024 and 2025.
Right.
Indications suggest those rigs will return this year, so that market is bottomed and maybe on the cusp of an upswing. So this deal will give Transocean the ability to participate in that recovery.
So in terms of why now, when it comes to the timing of this deal, the CEO of Transocean cited a multi-year drilling upcycle. Where are we in that cycle? Are we, first inning? Are we third inning?
It's kind of been an interesting upcycle. So we saw an inflection in 22 and 23, and 24 and 25, we've seen kind of a plateau to a slight pullback. Now, I do believe we're in a recovery and have been, and this has kind of been more of a mid-cycle pause associated rather than a downturn in offshore drilling. So I do think the recovery is intact, but I think the cadence has certainly slowed and in fact deteriorated. And offshore drillers like energy service companies have been off to the races this year. I think the oil price has held in better than expected. Some of that is due to some of the tensions in the Middle East, Iran, etc., Venezuela as well. So the punchline really is that we're still in, I think, a mid-cycle pause until maybe the second half of this year. And in terms of what inning we're in, I think we're probably like third, fourth inning, but it's been in kind of an unconventional recovery.
Will the regulators allow these two companies to get together?
Yeah, I think so, and it's a good question. These are the two of the largest players that are out there, and Rig's CEO expressed extreme confidence that that will be the case. It's a competitive market. There's a lot of fragmentation, smaller players in the market, and it's generally the quality of certain assets that determine which guys win which contracts. A lot of it depends on which rigs are capable of drilling for which projects. And so, no, I do think that this should get a relatively quick approval. Certainly, they're talking second half of this year. That's a much shorter timeline than the last major oil field services merger, which was Schlumberger ChampionX. That took over a year to a year and a half to approve and required significant divestitures. But offshore drilling is a different market.
Our thanks to Scott Levine, Bloomberg Intelligence Senior Energy Services Analyst.
Staying with energy, on Bloomberg Intelligence, we often look at research from Bloomberg NEF, previously known as New Energy Finance.
So they're the team at Bloomberg that tracks and analyzes the energy transition from commodities to power, transport, industries, buildings, and agriculture sectors.
This week, we took a look at robotaxis. For more on this and the state of the automated vehicle industry, I was joined by Andrew Grant, BNEF Head of Intelligent Mobility. I first asked Andrew to tell us where we are with robotaxis and what we should watch out for in 2026.
So at the end of 2025, there were about 8,000 working robotaxis globally. Some of those had safety drivers behind the wheel. Some of them had safety drivers in the vehicle, but a significant number fully driverless and operating in various cities around the globe. I'd say about half of those 8,000 based in the US. But we expect that number in total to more than double by the end of the year to around 18,000 robotaxis globally.
Who are the players in this business? Names, other than Tesla, Waymo. How do you think about the competitive environment out there?
I mean, we spend a lot of time looking at the actual operations and number of vehicles deployed. So really, you're looking at kind of 4 companies globally that have the biggest fleets of vehicles on the road. So Waymo, as you mentioned, Alphabet-backed, and has just raised a significant amount of money. But also, you're looking at 3 Chinese companies with a big robotaxi fleet and growing. So Baidu's Apollo, and then WeRide and Pony AI, which are robotaxi specialists that are based out of China but looking to expand globally.
I think about the battery electric vehicle market, and I think with the exception of the U.S., BYD and some of these other Chinese manufacturers, it just feels to me at this early stage might be able to take over the world of electronic vehicles. Is that a similar view for robotaxis?
Yeah, I mean, it's interesting how different geographies are going to react, and different regulators are going to react to foreign companies coming in and deploying their technology in those areas. We are really seeing kind of a race at the moment for new territories. So you've obviously got the US-based companies, the Chinese-based companies that I just mentioned, and kind of in the middle, you've got Europe, Middle East, Southeast Asia, where a lot of these companies are setting up roots and looking to deploy. And kind of 2026 is the year where they're really looking to expand those services. So Uber has just announced in the earnings call last week that they'll be expanding to Houston, Hong Kong, Madrid, Zurich. There's a variety of really competitive battlegrounds across those kind of markets in the middle.
What's the safety record so far in these early testing stage?
I mean, it depends how you measure these safety standards. It's whether you're needing some type of intervention with the safety driver in the vehicle. On the whole, these vehicles are tending to kind of show safety records that are similar to what humans have displayed, and in some cases, it's far surpassing that. But again, the measuring of these standards is kind of a tricky, nuanced subject that a lot of regulators are digging into at the moment, and it's really about companies working with regulators to try and figure out and kind of try to prove their safety record over time as they expand their services.
Talk to us about these things are expensive to develop, maintain, deploy. Waymo just raised $16 billion at $126 billion valuation. Tesla's committed $20 billion in R&D this year. Where's the money coming from?
I mean, a variety of venture-backed investors and kind of the big tech companies themselves. So you mentioned Waymo. A lot of that money is coming from its majority owner, Alphabet. And then Tesla is putting a lot of money into this. It's also about where they are putting their money. So Tesla is going with a strategy of deploying a much cheaper vehicle, but they're putting a lot of money into the data centers to try and improve their self-driving algorithms and their self-driving system. Whereas Waymo's got a more expensive vehicle, kind of 2 to 3 times at a minimum, more expensive. So it's going to take a lot of money to kind of build out that robotaxi fleet and deploy it in the various parts of the globe where they want to deploy. They've just announced that they plan to launch a service here in London in September.
Great. Some of those little streets. Good luck there. What's some of the gating issues here? Is it regulatory? Is it capital? Is it technology? What's the gating issue here for this industry at the moment?
I mean, it's kind of all of the above, and there's improvements that need to be made on all of those, but also just finding a business use case for these services. I mean, as we've been talking about, it takes a lot of money to build them and deploy them. So finding a kind of meaningful market for them and completing kind of useful rides or meaningful rides rather than just kind of being a theme park attraction driving small parts of the city. You actually want to kind of get those more lucrative ride-hailing trips from, say, city center to airports. And that's been a bit tricky for some of these robotaxi companies to actually sort out. They, if you look at just about a week and a half ago, Waymo announced that they would be opening up to San Francisco airport. But really what you're seeing from that is they are doing pickups and drop-offs at the car rental center, which is kind of a 15, 20-minute journey from there to the actual airport itself. So it's kind of compete with curbside drop-offs from ride-hailing vehicles. They still have a bit of way to go.
Our thanks to Andrew Grant, BNEF, Head of Intelligent Mobility. Coming up, a look at why Coca-Cola offered a more conservative full-year sales outlook than expected.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
You can access Bloomberg Intelligence via BI Go on the terminal. I'm Scarlet Fu.
And I'm Paul Sweeney, and this is Bloomberg.
This is Bloomberg Intelligence with Scarlet Fu and Paul Sweeney on Bloomberg Radio.
We move now to some news at the food and beverage company Kraft Heinz.
So this week, Kraft Heinz's new CEO, Steve Cahillane, halted the process of splitting the company.
Its decision, he said, was backed by the board of directors. Cahillane will instead invest $600 million in developing new products, marketing them, and lowering some prices.
The shift in strategy was the result of Cahillane spending the last few weeks immersing himself in Kraft Heinz's vast portfolio, including conversations with retailers and employees.
For more on all this, we're joined by Kristina Peterson, Bloomberg News food industry reporter.
We began by asking Kristina to explain Cahillane's thinking with the pause.
He's only been on the job since January 1st, so I think this came as a surprise to folks that the split was called off about 5 months after it was announced, or paused. There is no end date to the pause, so we don't know if it will at some point resume. But the CEO, Steve Cahillane, said that he came on the job knowing that there had been levels of underinvestment in Kraft Heinz's brands and decided that after reviewing all of them, that there were brands that would respond to more investment. So they announced that they would be putting $600 million into things like R&D, marketing, and lowering some prices in hopes that that would bolster the entire company and that would be in a better position, put them in a better position to evaluate whether they should move forward with the split.
So what do most investors want? Do you think they want the split up? Sometimes split ups work. A lot of times they don't. What have investors been saying over the past months?
There's clearly been some anxiety among investors since the news of the split was announced. I think that the new CEO was seen as there were hopes that he would do what he had done with the Kellogg company, which split into two publicly traded entities, and then were both of those companies were bought by privately held entities. So there was some speculation that the same thing would occur at Kraft Heinz, and Cahillane said basically not yet.
Really?
There's another twist to all of this, which is that Kraft Heinz's biggest shareholder is Berkshire Hathaway. And Warren Buffett, who runs Berkshire Hathaway until he handed the reins to Greg Abel, said he was never a fan of that idea to split up the company. I mean, he was kind of the mastermind behind Kraft Heinz becoming the behemoth it was, and that didn't work out so well. But he made clear that the split was not a good thing in his mind. Do we think that has anything to do with this about-face?
I don't know. It is clear that he had publicly expressed disappointment in the split, and his successor had said in a filing that Berkshire Hathaway was taking steps to sell its 28% stake in Kraft Heinz. So clearly they were nervous about this and not fans of the news. So
do we have any idea how long this pause will last? I mean, is he trying to turn stuff around, make it maybe better? So if when they do split it up, it will be worth more? What do we know?
They clearly are not going to make the decision this year. They talked about returning to growth in 2027. So it seems like this is a months away decision.
Oh, the investment bankers who had that on their deal sheet for 2026.
But they get paid in the meantime for the work that they've done, right?
Nah, you don't get paid until it closes.
Oh, really?
Yeah.
You can't bill them along the way
no,
like
we're
lawyers?
not lawyers. Okay, we get paid.
Oh,
We take a cut of the.
I like how you still say we.
Yeah, exactly.
Because you feel for these guys.
Yeah. What does the company want to do now as a standalone company?
Well, they've talked about releasing some healthier products. They are launching a Kraft Heinz mac and cheese Power Mac with protein and fiber.
I knew it.
And they will be lowering prices. They talked about the opening price points being important for low-income families. So those are some of the areas that they're going to be focusing on, some healthier options, more affordable price points.
Our thanks to Kristina Peterson, Bloomberg News food industry reporter.
We move now to the beverage giant Coca-Cola. This week, Coca-Cola reported weaker than expected quarterly sales.
The soda maker also offered a more conservative 2026 full-year sales outlook than expected. Shares of Coca-Cola fell after the news.
The outlook points to the challenges faced by the incoming CEO, Henrique Braun, as the company works to win over shoppers with its widening portfolio of beverages.
For more, we heard from Ken Shea, Bloomberg Intelligence Senior Consumer Products Analyst. We first asked Ken to tell us what's concerning investors about Coca-Cola.
I think what may be concerning the market a little bit about Coke is that the mix was not as favorable as it had been. Also, the company over the past couple of years had been relying heavily on price mix to boost the top line. It was a considerable slowing in the quarter. Having said that, there's always some noise in the fourth quarter. It's hard to draw too many conclusions from the fourth quarter. But I think the market is also being spooked a little bit by the guidance for next year, which came in a little bit light. The company's long-term algorithm is to generate about 4 to 6% organic revenue, and from that, it can generate high comparable EPS growth, and it did that in 2025. In 2026, though, they're saying 4 to 5% top line and 4 to 5% EPS growth, and so that's EPS growth. Again, that's excluding currency effects. Is not only below their long-term algorithm, but also below consensus expectations going in.
What's the, we always talk a lot of your companies, the consumer products companies and staples companies, you think about them as kind of a GDP, maybe a little bit GDP plus kind of growth here. Is there any secret sauce to the Coca-Cola story, or is that the way we should think about it?
Well, there's a lot of truth to that, Paul, because Coke is in like 200 markets around the world.
Wow.
I guess the way for growth is lunar at this point. I mean, they're everywhere. But I think there's going to be a new CEO on March 31st, Henrique Braun. He's a longtime veteran at Coca-Cola. He was the COO, used to head up the Latin American operations. I think there's a lot of confidence in his ability to take the reins here. And I think what he's going to spell out in his vision next week at CAGNY, that's when they usually do it.
That's where you'll be.
Well, I think he's going to say that they need to step up their marketing and innovation here to boost that top line growth. And I think they're going to talk a lot about functionality, something that we talked about with PepsiCo. What do I mean by functionality? Well, consumers want more from their beverages than just taste good and hydrate them. They want it to not only have zero sugar, but it wants to have more electrolytes in their water. It wants to have more protein in their drinks, particularly the GLP-1 crowd. They want to have fiber, which Coke offers in its prebiotic sodas like Simply Pop. So these are the kind of things they're going to talk about in terms of product innovation, I believe, next week. And in addition to that, I think the company's going to spend more on marketing, digital marketing, to get the message out to new, young consumers.
I guess the idea is to just have your drink replace your food. at
guess
this point.
protein.
Zero sugar actually was a standout, right? With Coca-Cola Zero Sugar posting double-digit volume growth in the quarter. When you say that they want to focus on the innovation and get the word out, what does that mean in terms of spending on marketing? What does that mean in terms of capital expenses?
Well, I think broadly speaking, more social media advertising. I mean, on a per view basis, that's a lot more cost efficient than the traditional ways like television. Paul, you would know that, right?
Mm-hmm,
Media analyst days. So it's more of that. It's also working more closely with their bottlers in terms of co-marketing ventures. That could be a wide range of things, not only digital marketing, but perhaps coming out new packaging, whether it's multi-packs to attract an economical consumer, to spending more on its fountain dispenser. You see a lot of fast food restaurants where they can make their own sodas and so on. So spread that out more to have more consumer engagement, no matter where they are.
Yep.
So I see more of that.
Our thanks to Ken Shea, our Senior Consumer Products Analyst.
We move next to news on the toy and board game maker Hasbro.
This week, Hasbro reported that it more than doubled year-over-year revenue from its popular card game Magic the Gathering in the fourth quarter. Shares of Hasbro jumped after the news. So we brought in Lindsay Dutch, our Consumer Hardlines Senior Analyst, and began by asking her to break down Hasbro's results.
So the story for Hasbro is, the results in 25, including the fourth quarter, is really being driven by their Wizard of the Coast digital gaming segment. That segment has been growing rapidly, 45% on the year, 60% I think for Magic the Gathering in the quarter. So just tremendous growth coming out of that brand, better than expected. And that unit is really going to carry the growth in 2026. The outlook for the consumer products, with their toy segment, is still kind of weak. So it's really coming out of that digital gaming segment. But I think investors are pleased with the outlook there just because they're lapping very difficult comps. So to see solid growth in 26 coming out of that, it was a good surprise.
Lindsay, what about tariffs? Is this something that Hasbro has figured out and it's no longer something that leaves its earnings to be kind of unreliable and they've kind of smoothed things out?
So it definitely affected the year. So about $40 million in the fourth quarter, a headwind for margin there, especially on that consumer products segment. So that margin did decline year over year, which was a disappointment. It's certainly going to be a headwind for profitability, at least in the first half, and comps will get easier in the second half. But Hasbro did note that, much of the cost savings program that they're working on and other supply chain efficiencies, they were able to offset a significant portion of that cost. So that is a good sign, but there's still a little bit of a headwind for the next 2 quarters.
I'm just looking at the FA function on the Bloomberg terminal. It gives me all the financial analysis. And boy, the operating income profit for the Wizards of the Coast and the digital segment is huge, whereas the profitability of the regular toy business, not so much. Is the company just throwing all the resources into their digital stuff? Is that the strategy?
So they have definitely been pushing for several years now to become a bigger player in that digital world, but also really to become known for that. So I would say, one of Hasbro's big brands, Monopoly, that's what many people know the company for, is that traditional Monopoly board game. But they are pushing into this world of digital games. They want to be valued as such. And I will say, they do have a digital version of Monopoly, Monopoly Go, and that has done very, very well over the past couple of years. It continues to surprise, including in the fourth quarter. So they're definitely moving in that direction. But that toy segment, consumer products, still is pretty large. It was still around 50% of revenue for 25. I do think that mix will come down over time, but it's still a big piece of their business that they can't ignore.
Lindsay, I also noticed that in this latest earnings report, they announced a $1 billion stock buyback authorization. I believe this is the first buyback since 2018. What does that signal to you?
I think that Hasbro is still working through their capital allocation priorities. They are still focused on reducing leverage. Their dividend has been flat for quite some time. So I think they're looking at different avenues now that they're in a much better financial position than they had been maybe a year or two ago. So I think it's just a signal that position is solidly better, and they're looking to redeploy cash in different ways that they maybe couldn't have done a year or so ago.
Our thanks to Lindsay Dutch, Bloomberg Intelligence Consumer Hardlines Senior Analyst.
Coming up, a look at why CVS Health is repeating its profit guidance for 2026.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
You can access Bloomberg Intelligence through BI Go on the terminal. I'm Scarlet Fu.
And I'm Paul Sweeney, and this is Bloomberg.
This is Bloomberg Intelligence with Scarlet Fu and Paul Sweeney on Bloomberg Radio.
We move next to earnings from the telecommunications company T-Mobile.
This week, the company reported quarterly revenue that beat estimates, but had earnings that missed analyst projections. T-Mobile also reported it added fewer mobile phone subscribers than analysts expected last quarter.
This comes as the company aims to distinguish itself from competitors in value and network quality with promotions like free Netflix subscriptions and Wingstop Chicken.
For more, we brought in John Butler, our senior telecom analyst.
We first asked John to break down why this could be considered a disappointing quarter at T-Mobile.
I think one of the things that really impacted them is we've seen Verizon, which now has a new CEO who's come in. He's very volume focused. So he's out there. They're promoting heavily. They're trying to win new subscribers. And I think it took a bit of a dent out of T-Mobile's growth in the fourth quarter. I think one thing T-Mobile did, which was smart, is they combined the 4Q report with a Capital Markets Day update. They updated their 2027 guidance, and they increased their free cash flow outlook for 27 by $1.5 billion. And so when you saw them do that, you saw an inflection in investor sentiment almost instantly, because again, this has gone from a story of revenue growth. Now they're pivoting more to free cash flow growth. They're really pointing investors to that bottom line to get the focus off of revenue growth as things get more promotional and as industry growth slows.
So is this a new wave of just, I guess, across the board? If Verizon's getting a little bit more promotional, does T-Mobile to AT&T, do they have to respond, or are there other things they can do?
So great question, Paul, right? We're in a mature industry backdrop now. Growth overall is slowing for everyone. T-Mobile is not alone in pointing to free cash flow growth. You've got AT&T and Verizon doing the same thing. And so I think, again, with that new CEO in place now, you've got T-Mobile sort of driving a growth story that centers on not only smart promotion, but also driving into adjacent markets like advertising and even credit cards.
Yeah, I'm a T-Mobile subscriber, and there's always a ton of emails from the company offering all kinds of different services and deals. And it really feels like they're just trying to envelop you into their ecosystem. John, I kind of call the effort to sell internet access to add broadband customers a side hustle for these telecoms companies. But this is how they can make sure that they continue to build out their customer base, even as they try to fight for market share when it comes to mobile phone subscribers. How is that side hustle going for T-Mobile?
So the side hustle, as you call it, and I think that's a good word for it, is still small right now. I think the real opportunity for them in the near term, Scarlet, lies in the broadband business. They're pushing into fiber, another side hustle. It's small, but I think over the next couple of years, it could increasingly contribute to growth. And then at the core of the broadband business is their fixed wireless access business. So delivering broadband to the home over cellular spectrum. That's been very popular, and T-Mobile remains a real leader there. It continues to be a growth engine for them. And so I think when you pair that with the ad business, the credit card business, and more importantly, the fiber business, it all adds up to help sustain that free cash flow growth and call it the 5 to 6% range, maybe even more as we go forward over the next 3 years.
John, just about 30 seconds. Dividend policy, T-Mobile's got a 1.8% yield, Verizon 5.6%, and AT&T 3.9%. So there's something for everybody in terms of investors. Does T-Mobile, do they worry about their dividend yield?
Little less so than share buybacks. In fact, one of the things they did with Capital Markets Day was announce that they're buying back $5 billion in shares over the course of the first quarter here, which is double the normal rate. So, I think they're leaning more into that than dividend growth, although it's part of that share buyback program, and it's going to continue to be as we go forward here.
Our thanks to John Butler, Bloomberg Intelligence Senior Telecom Analyst.
We move next to some news from the healthcare company CVS Health.
This week, the company disappointed Wall Street by repeating its profit guidance for the full year.
It's a move analysts are calling a letdown after a strong fourth quarter performance.
And it comes as CVS faces scrutiny from lawmakers and regulators in Washington who are concerned about the rising cost of healthcare.
For more, we were joined by Jonathan Palmer, Senior Equity Research Analyst at Bloomberg Intelligence.
We first asked Jonathan to give us his take on the latest results at CVS.
I think what investors were really focused on was 2026. They had done an investor day in December and already laid out 2026 guidance, and they kept it the same. So that was a little bit of a sigh of relief for investors in managed care. Managed care has had a pretty challenging couple of years. Most recently, the Center for Medicare and Medicaid came out with some advance rates for Medicare payments in 2027 that caused all the stocks, whether it was United Health or Humana, to pull back pretty significantly. The important takeaway, I think, was that even though that happened and CVS is going to advocate for better payment rates, their goal of turning their healthcare benefits business around isn't really dependent on that, and they're still going to hit their margin targets in the future.
Did they talk about what kind of risks are involved? I mean, obviously, big policy risks remain a headwind here for not just CVS, but for the entire sector. But did they address how they're thinking through those challenges?
Well, the industry's been in the crosshairs of Washington for forever, and that hasn't really changed. I mean, interestingly enough, Senator Warren and one of the Republican senators actually just introduced another bill to break up these companies. So that's, I think, table stakes for them. They're always in the crosshairs here. Whether we actually see some huge sea change out of Washington, I mean, I think the odds are better than they were in the past, yes, but I don't know that a lot of people or investors worry about that on the day-to-day. I think it's a pretty low % chance that these companies get broken up anytime soon.
What's the call on the CVS and this peer group here of healthcare? Is it supply chain? Is that the sector? Or
it could be.
Okay. I have no idea. Your industry, I have no idea.
I think of it as healthcare services.
Okay, that's good.
More broadly. And so that encompasses everything from the managed care companies to hospitals, to distributors, everything under the sun.
I watched The Pit, though. So I am getting smarter about the whole emergency room thing.
I think the call here is we're very much in a holding pattern in this world of managed care. There's a lot of things swirling around in terms of these Medicare rates and star ratings and really like the nuances of how they run their businesses. And there's been a real hard, how do I say this, era of compression and margin for those businesses. And everybody's trying to build that back up. And it's, when you're contracting and you have members coming in and out of plans and you're dealing with the government, these things don't get fixed overnight. So I think a lot of people are waiting for more clarity on where things are going and can the improvements that a lot of these companies have talked about actually show up in the numbers.
Who would you say is CVS's main competitor? Because it's a vertically integrated healthcare company. It's no longer a drugstore. Managed care is a big part of its business. Once upon a time, I might have said Walgreens, but that's not the case anymore.
Yeah, I mean, they're very clearly the best-run pharmacy out there now that Walgreens has succumbed to private equity, and we've seen Rite Aid just go out of business. I mean, they're the best peer comparison is United Healthcare, but even then, they're very different animals because United Healthcare owns a lot of technology assets that CVS doesn't. They also own a ton of provider assets that CVS doesn't. But in the areas of managed care and the PBM, they match up pretty well. And then there's Cigna in that business, those two businesses as well.
Our thanks to Jonathan Palmer, Senior Equity Research Analyst at Bloomberg Intelligence.
We move next to news from the hospitality giant, Hilton Worldwide.
This week, Hilton reported fourth quarter earnings that beat analysts' expectations.
The company's ability to add new hotels to its global network ended up driving growth.
For more on this, we are joined by Brian Egger, Bloomberg Intelligence Senior Gaming and Lodging Analyst. We first asked Brian about what Hilton reported from an earnings perspective.
Yeah, so I mean, what we saw in the quarter was kind of mixed in terms of U.S. being down a little bit or maybe a little below RevPAR in the fourth quarter, mostly because of the government shutdown. So a bit weaker inbound travel to the U.S., a little bit weaker government travel. But the outlook for next year, for this year, 2026 is pretty good, 1 to 2% RevPAR growth.
That's revenue per available room.
Per available room, yeah. And so leisure, group, luxury, all kind of strong. International, a little stronger than the U.S. But although this is an aging upcycle in the lodging industry, it's still got some legs to it.
Now, Hilton, along with many of the other hotel companies like Marriott, has a asset-light business model, which means that it's brand licensing, right? They don't actually own and manage any of their own properties, and that allows it to move more nimbly. The profit margins are much higher. What's the downside of that, Brian?
So, I mean, there's some benefit to actually owning the real estate when you're really in an upcycle, but this kind of fee-based model is a very capital-efficient way to expand and grow. You get your franchise fees and management fees. They've got a little bit of owned hotel exposure as well, but most of the lodging companies separate from the REITs are actually asset-light manager franchisors with some owned assets.
Yeah, I'm looking at, you got a company with, $13 billion of revenue, call it, $4 billion of EBITDA, $100 million of CapEx. Are you kidding me? That is awesome. So who builds if Hilton wants to build a new hotel in South Beach, they don't build it, somebody else builds it?
Yeah, so you have like ownership entities. Obviously, you've got the REITs like Park Hotels and Resorts and others that own the real estate. So this is, as you said, like an asset-light, franchised, management tree-driven business with some owned hotels. There is some owned hotel exposure.
So what do they do with all the free cash flow every year? They got, most of that EBITDA goes down to the free cash flow line.
They have been returning capital, right? So they've got capital returns. And, there is real opportunity for growth within their business model. And a lot of that is international, a lot of conversions, a lot of conversions from other assets that fit very well under their brand flags. And they have also been launching some new brands as well in kind of that lifestyle category.
How many brands do they have right now?
So where are they now? I know Marriott's 31. I'm trying to remember what Hilton's count is right now.
So that's all those 31. Is that just slicing and dicing the market?
Yeah, it is. I mean, I think overall, if you slice the market segment-wise, Hyatt and Marriott are more prominent in the luxury highest end. Hilton has some luxury, but it's also got a very solid kind of mid-scale limited service portfolio. And so what you tend to see is that in this environment, luxury upscale tends to outperforming. And the limited service is somewhat weaker, partly because that's where you've got the government travel, you've got the transient independent business travel. But stuff like leisure, group, luxury, particularly international markets, UAE, Europe, non-China, Asia, all have been really quite strong.
That was Brian Egger, Bloomberg Intelligence Senior Gaming and Lodging Analyst.
That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
And remember, you can access Bloomberg Intelligence via BI Go on the terminal. I'm Scarlet Fu.
And I'm Paul Sweeney. Stay with us. Today's top stories and global business headlines are coming up right now.